Welcome to Good to Know in Buffalo, an informational program presented by the City of Buffalo Office of New Americans. The Office of New Americans in Buffalo is an office in City Hall that was established by Mayor Byron Brown in 2015. The office, or the ONA, works to ensure that Buffalo remains a welcoming city and a preferred resettlement site in the U.S. We make sure that our immigrant communities are highlighted, and our mission is to promote access to city services. With this program, we're able to present information that our city's refugees, immigrants, and residents are looking for. My name is Jessica Lazarin, and I serve as Director of the Office of New Americans. At the Office of New Americans, or ONA, we get a lot of questions about income taxes and how to file a tax return. In the United States, there is a government agency that collects taxes and enforces the tax laws in this country. It is called the Internal Revenue Service, or IRS. Within the IRS, there is also an independent organization called the Taxpayer Advocate Service. Today, to talk to us about income taxes, we have a representative from the service. Her name is Elizabeth Blazel-Penny.
I'm going to talk to you about a fundamental issue that almost all Americans have to deal with, and everybody who works and lives in the United States has to deal with, and it's called income taxes. So today we're going to discuss a little bit about where I work, the Taxpayer Advocate Service, just so that you know where I'm coming from. We're going to learn about the U.S. tax system. We're going to talk a bit about how taxes are determined so that you know how taxes work and can make the best decisions for you and your family about taxes. And then we're going to talk about your rights. There is actually a Taxpayer Bill of Rights, and I want to make sure that you're aware of it. So the Taxpayer Advocate Service is an independent part of the IRS, and that means that we report directly to Congress on many of the issues that we cover. Our organization has two primary functions. One of the things we do is we work on cases with taxpayers who have challenges before the IRS. Another thing that we do is we advocate for changes to the tax system to benefit taxpayers. So because we are independent, we are there to be a voice for taxpayers and to help taxpayers solve problems from within the system. Our services are free, and I'll give you information in just a while about how to contact our office if you ever need to. We have at least one Taxpayer Advocate Service office in every single state, including Puerto Rico, and you can find your local Taxpayer Advocate Service by going to taxpayeradvocate.irs.gov on the web. Our mission at the Taxpayer Advocate Service is simple. We help taxpayers resolve problems with the IRS, and we recommend changes to prevent the problems. So before we start getting too deep into our technical content today, I want to make sure you know how to contact us if you ever have a problem and you need to reach us. Our local phone number here in Buffalo is 716-961-5300. I have employees right here in the city. A live person will actually answer the phone or call you back if you leave a message. And if you come to our office, what happens is I will assign you to a case advocate. And that case advocate will work with you personally, one-on-one, to help you resolve your tax issue all the way through your case. So you will have a person to contact and you will have their direct line. Again, our services are free, and we help not only individuals with income taxes, we also help businesses, nonprofit organizations, trusts, and estates, and there is no income limitation to using our services. So what do we do in my office? We protect taxpayers' rights by ensuring that all taxpayers are treated fairly. So when you come into our office, we're going to look at the facts of your case, and we're going to advocate for you to help you reach the resolution that's proper under the tax law. If you qualify for help, your advocate is going to be with you at every turn. So let's talk a bit about the tax system. The United States has several different levels of tax, just like it has several different levels of government. So I work for the IRS, which is the federal level of government. A lot of people call it the United States government. And what that means is that the laws at the federal level are enforced in all of the states across the country. That's different than a state government. A state government may have its own taxing authority. So for example, New York State has its own Department of Taxation that's different than the IRS. The IRS is at the federal level. So today, we're specifically going to be talking about federal taxes. As Jessica mentioned, within the federal system, the Internal Revenue Service, commonly called the IRS, is the agency that administers the tax law. And there's a lot of different parts to administering the tax law. They make sure that people file and report the proper amount of taxes. They make sure that we collect taxes that are due. We try to make sure that people have enough information to do their taxes. And then my part of the agency advocates for taxpayers who run into problems. There's many other parts of the IRS, but that just gives you a general sense of the basic parts of tax administration. Our focus for today is going to be on income taxes. So income taxes are just one type of tax. You may have experienced other types of tax depending on how you engage on a day-to-day basis with your governments and with your local businesses. For example, at the state and local level, there are sales taxes when you purchase products. As another example, if you're a homeowner, you may pay property taxes, or you should pay property taxes. If you're a business, there can be different types of taxes on certain business products. When you buy gasoline, there's gasoline taxes. But today, again, we're going to focus on income taxes. So to understand income taxes, we really need to start by understanding income. And this is really at the heart of what income taxes are. So what is income? Income, in its broadest sense, is any money that you get from whatever source, unless it is excluded under the tax law from being counted in income. So income might come, for example, from a job. Let's say you work at a grocery store and you go to work every day and every week or two you get a paycheck. That might be one way that you get income. Or maybe you work in the trades, you work for a construction agency, or you clean houses on a by job basis. That might be another type of relationship where you get income by the job even if it isn't regular and at the same place all the time. You may drive for Uber, or you may have a space where you rent out space under Airbnb, and you may earn income from that. You may have your own small business. Maybe you knit and sell baby blankets, and you earn cash from doing that. That would qualify as income as well. In addition, maybe you own stocks or have investments. Even winning the lottery is going to be taxable income. It helps to understand income in some ways by understanding what is not income. So not every bit of money that you take in is necessarily income for federal tax purposes. Some common examples are gifts and inheritances. So a gift is what happens when somebody gives you money without the expectation of a product or service in return. It is detached, it is a generous gift just to you, and that is not considered taxable income. Inheritances, if somebody passes away and they leave you some property or some money, that is not going to be income for income tax purposes. In addition, a federal tax refund, if you file a tax return and you get some money back from the government, that's called a tax refund. That is not going to be taxable income. Where I see a lot of confusion about taxable income are on the small side businesses that people have. You know, maybe you watch your friend's child a few days a week and they just give you a couple dollars here and there. That still qualifies as income for tax purposes. And as you're earning income, one of your responsibilities as a taxpayer is to keep records of all of the income that you earn. So if you work for an employer, like that grocery store we talked about earlier, typically your employer at the end of the year will send you a Form W-2, and that W-2 will report all of the income that you earned. As another example, we talked about working in the trades. Maybe you work in construction and you work on several jobs for different people. At the end of the year, the people who paid you for those jobs, if they're a prime contractor and you're working for them, might send you a Form 1099. So forms W-2 and 1099 are two ways that you can help yourself track income if you're working for somebody else who's going to report the income. When you get a form W-2 or a form 1099, a copy is also sent to the Social Security agency who provides it to the IRS. So the IRS knows the same information that you know when you get those forms W-2 and 1099. Where the IRS has more difficulty tracking income is when you have your own business. When you have your own business, it's very important that you keep records of what you make during the course of the year. That might be in terms of receipts, it might be in terms of using records in a bank account, you might have formal accounting software, but you need to find a way to regularly track what you're making. And I'm going to tell you why that's beneficial to you as we go throughout this presentation. So we talked about income, and I think we have a general sense of what income is. Income's all that money that you're making and earning and tracking. What are income taxes? So in this country, our government expects all of the citizens who work and earn income to contribute their fair share of taxes. And what happens when the government collects those taxes is they use it for things that benefit everybody. So for instance, the tax dollars that people send to the IRS that are collected are used by the federal government to build roads and bridges, to build airports. It's used to make sure that our military is paid for, that different things are safe and secure, like when we go through security into government buildings. It pays for employees of the federal government who provide support services, who oversee national parks. It goes towards all sorts of shared services. And the expectation of being in the country and living and working here is that everybody contributes whatever their fair share of taxes are. So for income taxes, the way that we determine your share of income taxes is we gather all of your information, all of your tax information for the year, which is basically a summary of all of the financial things that happen to you during a calendar year. So from January 1st to December 31st of a given year, we determine how much income you made, and then we apply what's called a tax rate. And a tax rate is a percentage of that income that the government is going to take, and that represents your share of taxes. In this country, the percentage that we use to determine your taxes depends on how much income you make. So if you make more income, you might be paying a bigger share of your income in taxes. For example, if you make millions and millions of dollars, you may be closer to paying 20 to 30% of your income in taxes, whereas if you make $2,000 during the year, you may not be paying anything in taxes during that year. After we determine how much you need to pay in taxes, it's your responsibility to file your tax return, to report to the government how much you owe, and to make sure that that is paid. So let's walk through a few examples. So I'm going to go first through example 1. And I want you to just take 5 seconds to read over the facts in example 1, because we're going to keep coming back to this example and building on it. This is going to help you understand how taxes work. So example 1, step 1, you're going to earn income. In this example, we're going to talk about tax year 2017. So that's going to be January 1st through December 31st of 2017. In this example, you did 2 things to earn income during the year. You worked for a friend's business as an employee, and you earned $20,000. You also knit and sold baby blankets on the side, and you made $2,500 from selling the baby blankets. So you kept records throughout the year. Maybe you got a W-2 form from your friend's business, and you kept a logbook of your income and a bank record of your income for your baby blankets, and you added it up, and you determined that throughout the year, you made $22,500. For the sake of this example, we're going to pretend that the tax rate that applies to you is 10%. Now, I just want to be clear, I'm not saying your tax rate is 10%, but for the purposes of the example, 10% is an easy number to use to illustrate what we're going to go through. So if your tax rate was 10%, in step 3, we apply that tax rate. So 10% of $22,500 is $2,250. So in this example, during 2017, you would have earned $22,500 and you would have owed the government in taxes $2,250. And then in step 4, you would file your tax return and pay that amount. Okay, so that's the very basic building block that we're going to use as we go through our examples. Let's move into example 2. Okay, take a moment to read over where it says new facts. Okay, in example 2, we're sticking with the same facts we had, except you determined that throughout the year, in this business you had making baby blankets, you had to pay $500 to purchase the supplies that you used to knit the baby blankets. Well, under our tax system, if you're operating a business and you're earning income for the business, then you can deduct or take out your business expenses from your income before your taxes are calculated. And I'll show you how this works and how it makes a difference using this illustration. So again, your income is the same from the first example. You made $20,000 painting houses for your friend's business, and you made $2,500 knitting and selling baby blankets. And again, you had that $500 expense for baby blanket supplies. So what happens now is you take that $500 out of your baby blanket income before you apply the tax rate. So as you can see in our example, you had $2,500 of baby blanket income. You took out $500 for your expenses, and that means that you have taxable income of $2,000 from baby blankets. And you still have your taxable income of $20,000 from painting. So in this example, you have income of $22,000, and we're going to apply that tax rate of 10%. We're going to use the same tax rate for all the examples. So 10% of $20,000 is $2,200. So let's compare example 1 and example 2. Remember, in example 2, we had that business expense that came out of our income before we applied the tax rate. If you look at example 1 and you recall back, our tax in that example was $2,250. In example 2, our tax was $2,200. That means that by spending that $500 on baby blankets, we saved $50 in taxes. Okay? So what that means is, if you have certain expenses that are deductible, and that means that Congress allows you, that the federal government allows you to take it out of your income, you will end up owing less in tax. Okay, so the more deductions that you are entitled to, the lower your tax amount will be. For individuals paying income taxes, everybody is entitled to something called a standard deduction. And the standard deduction changes every year, or can change every year. So before you file your taxes for a particular year, you want to make sure that you look up what the standard deduction is. And here's how the standard deduction impacts you as an individual. You need to take all of your personal expenses that may be allowed to be deducted, and I'll give you some examples. Common examples of expenses that can be deducted for an individual are charitable donations, so maybe money that you gave to a charity or money that you gave to a church. As another example, we may have mortgage interest deductions if you own a home, or certain property tax or state tax deductions. So there are many things that you may be able to deduct from your taxes, and you have to add those things together and compare them to the standard deduction. And whichever is higher is the one that you're going to want to take on your tax return. So let's move on to example 3. We talked about how taxes work at a basic level where you earn income and apply a tax rate. And we talked about how deductions work when you take money out of your income before you apply that tax rate to get a lower amount of tax that you owe. Now we're going to talk about withholding. So withholding is something that happens when your employer, the person who hires you and pays you to work a regular job, if you have a regular job, takes money out of your paycheck on your behalf and gives it over to the government. So you may have noticed, if you work a regular job, that the check that you get as a paycheck, whether it's every week or 2 weeks or every month, the check that you get is not what your salary is. So for example, if you go to work at a grocery store and they tell you that you're going to be making $100 a week working part-time at the grocery store, at the end of the week, you're not going to get a check for $100. You're going to get a check for something less than that. And the reason is your employer is responsible for taking money out of your paycheck to pay different types of taxes. So money comes out of your paycheck to prepay your federal income taxes. It comes out of your paycheck to pay your state income taxes. It comes out of your paycheck to pay for Medicare and Social Security, which are other government benefits that you may be entitled to and that we pay into when we work and pay over employment taxes, which are the types of taxes that your employer has to withhold and pay over. So you will see that lower number, but that money is not just disappearing. Every dollar of that money should be accounted for because your employer should be taking it and giving it to the government on your behalf. So what that means is, throughout the course of a year, as you get paychecks and money is withheld from your paycheck, and your employer is turning it over to the IRS, you are growing a balance in your IRS account of prepaid taxes, so that when you file your tax return during the next tax filing season, whatever taxes you might owe are going to be compared to the amount that was withheld and turned over. So let's go through an example to illustrate how that works. So back to our original facts, in 2017, remember you made $22,500, $20,000 from painting and $2,500 from baby blankets. Well, let's say in this example that your friend who owned the painting business was an employer, so you had this regular job, and they withheld $3,250 from your paycheck and turned it over to the IRS during the year. So at the end of the year, what happens is you first determine the amount of taxes that you owe. So just like the first example, you earn $22,500 and 10% of that is going to be payable to taxes, so you owe $2,250. But before you even filed your tax return, your employer had paid over $3,250 in withholdings from your paychecks. So the IRS already has received $3,250 from you, and you only owe $2,250. So what happens? You end up getting a tax refund. You end up getting a check for $1,000, which is the difference between the withholdings and the amount that you actually owe. So a lot of times when people get tax refunds, it is because their withholdings were higher than the amount of tax that they owe. A lot of people don't really understand how withholdings work. So just knowing this can help you make sure your employer is taking out the right amount of money from your paycheck every single time that you're paid and paying it over to the IRS on your behalf, so that you can make sure that you're getting as close to your tax as possible. Now, a lot of people like to have extra money withheld because they like getting that bigger refund during tax filing season. And that's a great way to save up money because somebody else is regularly taking it out of your paycheck before it gets to you. I also work with a lot of people in our office who don't have enough withheld from their paychecks, and they end up owing money at the end of the year. And that can create problems if you don't have enough of a balance to pay your taxes. So it's important that your withholdings are accurate to make sure that you have enough money to cover your taxes. So let's go on to example 4. In example 4, we're going to talk about credits. So credits are confusing to a lot of people, and I want to spend a little bit of time explaining what a credit is. So credits, unlike deductions, come off of your actual taxes owed dollar for dollar. So remember when we talked about deductions, when we gave the example of you having expenses from your baby blanket business, we talked about how that is taken out of your income before you apply the tax rate. So what that means is you save some money in taxes from deductions, but you don't save $1 in taxes for every dollar in deductible expenses. You only save a percentage. So remember, we had $500 of baby blanket expenses in our example number 2, but it only saved us $50 in taxes. Credits are different. Credits save you dollar for dollar in taxes. And there are several different kinds of credits. Let's go through an example to talk about how they work, and then I'm going to talk about some different types of credits. So again, we have the same facts. You made $20,000 from painting. You made $2,500 from your baby blanket business. The new fact is you qualified for something called the Earned Income Tax Credit, which is a refundable tax credit. And I'll tell you what it means to be refundable in a minute. But for sake of this example, you have a credit of $5,250. So what happens is we first determine your income. It's the same as it's been the whole time. You made $22,500 in income. We apply that tax rate of 10%. So that means that you would owe $2,250 of income. But you're entitled to a credit. And a credit works sort of similarly to withholding. It acts in some ways like a prepayment on your tax account. If it's a refundable credit, then what that credit does is it brings your tax all the way down to 0, and if there's more left over, you actually get a check for the excess amount of the credit. Now, there are credits that are refundable, and there are credits that are not refundable. If something was not refundable, what that means is it can't bring your taxes below 0. It can take away all the taxes you owe and bring it down to 0, but you won't get a check on the other side. Refundable credits, and there are several refundable credits, actually allow you to get more out of the system sometimes than what you paid in. So in this example, where you had an earned income credit for $5,250, you will end up getting a refund for $3,000. Now this example is different than the withholding example we talked about. Remember, in the withholding example, your friend took money from your paycheck and paid it over to the IRS. And you ended up getting a refund of some of that money because you ended up paying more over in withholdings than you owed in taxes. In this example, notice there's no withholdings. You haven't actually paid anything over to the government, but you are still getting a $3,000 refund. Okay? Because of this, because you can often get more out of the system than you put in, refunds are often a source of fraud and abuse. And that means that the IRS has very stringent policies and systems to verify that people qualify for these types of credits. Now, I'm not going to get very into detail about how to qualify for certain credits today. That would take an entirely new session. But I want you to know that there is a lot of confusion out there surrounding tax credits, especially the earned income tax credit. I'm going to go through very briefly what the qualifications are for the earned income tax credit, but we're not going to get into examples. And I'm only going to touch on this credit because it is the most widely confused, and it is a source of a lot of difficulty for people because often people will claim it and may get money back for it that they really shouldn't have gotten back, and then they are going to end up having a debt to the IRS. Or often people claim it who do deserve it and are entitled to it, but maybe did not keep the records they needed to keep throughout the year and are not able to get the credit. This tax credit can be over $6,000 if you have qualifying children. So it's a lot of money. And again, this is money that you can get even if you don't end up paying anything into the system. And here's why. It's called the Earned Income Tax Credit because it is based on the income you earn. So something a lot of people miss about this credit is you do have to earn income to claim it. So a lot of people might receive certain types of funds that are not taxable, like Social Security, disability, or SSI payments. Those types of payments are not taxable income. So if that's all that you're earning, you can't claim the earned income tax credit. You have to actually earn income to claim the earned income tax credit. And if you earn income and you're claiming the credit, and you have children who qualify for the credit, you need to make sure that the children meet all the qualification criteria. So in order to be a qualifying child, your children need to meet two different tests. They need to meet the relationship test, actually technically 3 tests. They need to meet the relationship test, they need to meet the age test, and they need to meet a residency test. And what that means is, for age, your children need to be under age 19 at the end of the tax year. If they are a full-time student, they can be up to 26 years old. For relationships, and this is where we see a lot of confusion, especially in the New Americans community, because different cultures have very different definitions of what relationships are. Okay? For tax purposes, for the earned income tax credit, the child who qualifies has to either be your biological child or grandchild, meaning you are the parent of the child biologically, or it can be a niece or nephew, or a great niece or great nephew, meaning it's your brother's or sister's child, or their children's children. It can also be a child that you've adopted, or it can be a foster child, or it can be a stepchild, which means that it wasn't your child, but you married the child's parent. What we see a lot of are situations where people are essentially raising other people's children for a whole bunch of different reasons. And maybe the child even calls you mom and dad. But that child, if it's not your biological child, or if it's a cousin or a friend's child, isn't going to qualify for earned income tax credit purposes. So if you have any questions about who might be a qualifying child, there's a lot of information on irs.gov about what can qualify and what can't. So in addition to age and relationship, you also have to show that the child lived with you for at least 6 months and a day of the year. And what I recommend that you do is make sure that somebody, either in a business or in government, has your child's address on record, the correct address. So that might be your child's doctor's office, it might be your child's school, it could be, in some instances, even clergy. If you're renting an apartment, try to put your children's names on the lease. Anything that can show that the child lived with you might be something that you need to produce to show that you're entitled to claim a child for the earned income tax credit. So I'm not going to get too much more in detail on that, but I did want to explain the basics of how that credit worked, because it is a source of a lot of confusion, and it can often be a lifeline for people who really need that extra money at tax time, but you need to make sure that you qualify for it, and you need to make sure you're keeping records in case the IRS wants more information or has questions about whether you qualify for it. So in summary, we talked about income. Remember, income is any money that you're getting in from any source, unless it is something that is excluded as income. And we talked about common exclusions being gifts and inheritances, federal tax refunds, or Social Security, disability, or SSI payments are often common things that are not income. We talked about the tax rate. That's the percentage of your income that you owe the government as a taxpayer. We talked about deductions. These are expenses, money that you spend throughout the year that come out of your income before we apply the tax rate. And that results in a lower tax due. We talked about withholdings. This is money that your employer takes from your paychecks before they give you the paychecks and turns it over to the government ahead of time, so that when you file your tax return, you have a nice big pot of money waiting there to pay your taxes and possibly end up with a refund to you. And then we talked about credits. Credits are amounts that reduce the tax that you owe, sometimes down to zero if they're non-refundable credits, and sometimes, if it's a refundable credit, it may actually result in a refund to you of an amount even in excess of what you paid into the system. Okay, so thank you for bearing with me through all the mechanics of tax. I know that it can be tedious, But to be honest, a lot of people don't really understand how their taxes work. And helping to understand the mechanics of it, it helps you make decisions about your finances throughout the year, and it helps you understand how the system is applied. It also adds what we call transparency, meaning it helps people see through the big agency and all the technical language and all of the rules to the nuts and bolts of what really makes taxes work. There are several other tax terms that we're not going to get into today just because of our time limitation. There are certain things called exemptions. There are other types of things that can increase or decrease your tax liability, such as certain penalties and interest, but we're not going to get too far into those. What I want to talk about now that we've talked about how taxes work is what your obligations, your responsibilities, and rights are as taxpayers. So let's talk about tax returns. A tax return is a form that you complete and send to the IRS, and it reports on your financial transactions during the year. So all those things we just talked about, the income and the withholdings, dependents, people who depend on you, who live with you, and who you support, your credits, anything like that that is going to be a tax item is going to be reported on this form. And for individuals, most individuals file a Form 1040. There are some variations of the Form 1040, but just to keep it simple for today, the form you would most likely be filling out is a 1040. And the 1040 is going to help you calculate the taxes that you owe. So let's talk about whether you need to file a return. We talked a lot about income and the importance of tracking income. And part of the reason that you need to track income is because whether or not you file a return depends in part on how much income you make. So if you make below a certain amount of income, you actually do not have an obligation to file a tax return. There are some reasons you may want to file that I'll touch on in a moment. But what happens every year is that the IRS publishes a table of the amounts of money that people need to make in order to file a tax return. Now, it depends in part on your filing status, and it also depends on how much money you make. And by filing status, when you file a tax return, you can file as single, you can file as married, you can file as married filing separately. I'm sorry, when I said married, I meant married filing jointly, meaning you're filing with your spouse. You can file as married filing separately, meaning you and your spouse each file by yourselves. Or you can file as head of household, which means that you are the primary person supporting a household. And each of those filing statuses has its own rules that I'm not going to get into. But what you would need to do is go to irs.gov, and you can look at the chart, and for each of those filing statuses, and whether or not you own your own business, like the baby blanket business we talked about, it will tell you how much money you need to earn in order to have to file a tax return. If you have to file a tax return, it is your obligation to file one. That is to be in compliance with the law. So if you don't file a tax return and you have an obligation to do so, you are actually not in compliance with the federal tax law. So let's talk about why you should file. So we talked about the fact that it's required by law, and this is obviously a very important factor. Everybody's responsibility as a taxpayer is to come forward and file their tax return if they have a filing obligation, if they have to file because of the type of income they make or the amount of income they make. In addition, filing a tax return can help you establish a financial identity in this country. It can help you establish how long you've been here. It can help you establish yourself and your own account with the government. It can help you establish credibility, and it can help show that you're in compliance with the tax laws of the country. In addition, tax returns are often required for certain loans. So if you want to maybe start a business and you go to a bank or a credit union to try to get a loan, or maybe you want to purchase a home and you go to get a loan, often they're going to want to see your tax returns that you filed, because that's a good way for them to verify what your income was. And they want to look at your income to see if you're somebody that they can lend money to. So having regular tax returns filed that properly report your income is a great way to keep track for potential loan purposes of your obligations, of your income and your expenses. In addition, we talked about refundable credits, right? That earned income tax credit that we used in our last tax example, you have to file a return to get that. So sometimes, even if you didn't pay money into the system, or even if you don't make enough to have to file a tax return, you still might be eligible for some credits, and you have to file a return to get that money. Also, if you have a regular employer and they withheld money from your paychecks, like in the example that we discussed, if you withheld more than you owe, you have to file a tax return to get that refund back of the extra withholdings. Otherwise, it just sits there. So you want to make sure that you're filing your tax return to establish your identity, to comply with the law if you make enough income that you have to file, but also to make sure you're getting back what you're entitled to in refunds, because the IRS won't just issue you a check. They want to make sure that you qualify, and you have to do the legwork of reporting that to the government. So when do you file a tax return? Tax returns are due once a year. They're usually due on April 15th. Sometimes if the 15th falls on a weekend, they'll be due the following Monday or Tuesday. So in 2017, they're due on April 17th. In 2018, they're due on April 17th. But you can always check on irs.gov when taxes are due. But if you get them in by April 15th, when your tax returns are usually due, you're always going to be safe. So let's talk about what you need to have to file your tax return. If you recall, we talked about a tax return being a form that you need to report information on. So what types of things do you need to report? Well, for you, you're going to need proof of your income. So remember we talked earlier about how important it is to keep track of your income during the year. This might be a Form W-2 or a Form 1099 where somebody else paid you and you have that form ready. It also might be a record of income from your own business or from money that you made on the side or from Uber or Airbnb or something like that. But you need to make sure you have all the records of the income you made. And also all the records of the expenses or deductions that you might be able to take. So your charitable donations, your mortgage interest, your property taxes, and your state taxes that you paid. You're going to want to have records of those things that you spent money on that might be deductible from your income. You're also going to want to have your Social Security number or a tax identification number if you don't have a Social Security number. And you also need a Social Security number or tax identification number for your dependents. And keep in mind that to claim certain types of credits, you're actually required to have a Social Security number, or your dependents are required to have a Social Security number. So that can sometimes play into whether you're eligible for credits or not. So aside from your Social Security number or your tax identification number, which you can get if you don't have a Social Security number, and your income and your expense records, you need sometimes to have records of, as we talked about, that you lived with your children during the year, or birth certificates for children to show their different relationships and their different ages. If you have a return prepared by somebody else, which we'll talk about in a second, they may ask you for this type of information because they're required to verify that you are eligible for certain types of credits or to claim certain things on your tax return. If you're filing your tax return by yourself, and there are resources to do that, there's a website called Free File. If you can navigate that, it is only in English, unfortunately, as far as I know. But if you can navigate that system, you can report on your items by yourself. It'll ask you questions and you'll fill in numbers and information. If you're having your return prepared, you need to make sure you have all your documents with you when you go to have your return prepared. How do you pay your taxes? Okay, so there's a lot of different ways to pay taxes. We talked about them. The first is withholdings. Those are, again, pre-payments that your employer takes out and pays over for you. There are also estimated tax payments. If you have a business and you don't have money coming out of your paychecks and being paid over to the government through withholdings, you actually have an obligation to make estimated payments throughout the year to make sure that you have enough to cover your taxes at the end of the year. And there are calculators on irs.gov that can help you determine how much you might need to pay over. But just know that if you do have a business, and it's not a tax-exempt business, you have to pay taxes on the income from the business, that you do need to make those estimated payments during the year. In addition, at the end of the year, if you prepare your 1040 and you end up owing something in taxes, you can write a check or make a payment with your return when you send it in. Your obligation as a taxpayer is to pay when the return is due. So your payment is due at the same time as the return. Now, there are some times, remember I talked about, where people don't have enough coming out in withholding and they end up owing money. If you can't pay, if you don't have the resources to pay your taxes when they are due, it's still important to pay what you can and try to get into some sort of payment arrangement with the IRS. And I'm not going to get into too much detail about payment arrangements. The most important thing to remember is that the IRS wants to help you comply with your tax obligations. We want to help you file, and we want to help you pay. And again, if you run into problems with these types of things, you can always come to my office and we can problem solve your tax issues when they come up. Hopefully they won't, but just know that there are resources. So how do you know if you paid the right amount? Well, as we talked about, your 1040 is going to help you calculate what you owe. So you can look at your 1040 to figure out what you owe in taxes. In addition, if you need help figuring out how to complete your 1040, because it's not the easiest form in the world, there are resources available to you. There are actually free services that prepare returns. They're called VITA, or Volunteer Income Tax Assistance Programs, and they can help you if your income is below a certain amount or if English is not your primary language. They're authorized to prepare returns for you for free. In addition, there's tax counseling for the elderly sites, and those are also programs that the government pays for to help make sure that our elderly citizens have their taxes prepared in the right way and have the assistance they need. There are also paid return preparers. You can go to somebody else who prepares returns as a profession, and you can pay them to prepare the return for you. And you can also do online preparation through a whole bunch of different softwares or through the Free File program, and they ask you questions and you fill in information and they will get you to how much you owe in taxes. And it's that amount that's on the 1040 that you need to pay. Now remember, you may have some prepayments on your account from withholdings or from estimated taxes. So if that's the case, you might not need to write a check for everything you owe because you may have already paid some of it. So where can you go for help? Okay, the IRS has a helpline, but it is really for simple questions. So if you have, and I know it's hard to know if your question's a simple question or not because you don't know the answer to it and you don't know the tax law, and that's okay. Nobody expects that. But I want to make sure you have resources to go to if you do have questions. So you can call 1-800-829-1040. That is the IRS's free helpline. Now please know you may be waiting for a while to talk to somebody and they can only answer simple questions about taxes. So if you have anything really complex, that's not going to be the best place to go. There are translation services available also when you call the IRS. You can also go to irs.gov. There are several pages that are available in different languages, and if you can navigate it in English, there's a wealth of information available about almost every tax topic. You can also go to the VITA or the TCE. Those are the two tax preparation services sites. You can bring your information there, and the return preparers there, again, that's a free service, they will be able to answer a lot of your questions for you or direct you to another resource. You can go to tax professionals. There are also free legal service clinics called low-income taxpayer clinics, and if you make below a certain amount of money, and it depends on how big your family is, you can go to these low-income taxpayer clinics. The two closest ones to Buffalo, there is one at the Volunteer Lawyers Project in downtown Buffalo. There's also one at Syracuse University. So those, again, are free services. If you are having a tax problem and you need to talk to somebody, in a legal way, you can call them and they can assist you. And as I mentioned, you can come to my office. We are there to help. We're there to advocate for you, to be your voice. If you have a tax problem, you can call us, and we also have translation services available in any language that I can think of. So the last thing I want to get into is the Taxpayer Bill of Rights. So the Taxpayer Bill of Rights was actually put into law by Congress in 2015. And what I want you to get out of this is to know that even though you have a lot of responsibilities as a taxpayer, and the tax system can create a lot of burdens and it can be very difficult, you also have rights, and you have very specific rights. And it's important to know what they are to make sure that you are being treated properly by the IRS and by the tax system. And part of why my office exists is to make sure that you are afforded your rights as a taxpayer. So if you feel like your rights have been violated, that's a great reason to call my office, and we'll talk about it and see what we can do. I want to go through the rights very briefly. There's 10 of them. So you have the right to be informed. That means you have the right to know what is going on with your tax account, to know what decisions the IRS makes, to know why they are making the decisions they make in a way that you can understand. You also have the right to quality service. That means you have the right to prompt and courteous service in your language. You have the right to speak to a supervisor at the IRS if there is an issue that comes up and you feel like you're not getting proper service by the employee you're working with. You have the right to pay no more than the correct amount of tax. And that means that if you report the wrong amount of tax on your tax return, you have the right to amend your tax return. You have the right to come back to the IRS and challenge them if they think you owe more than you do. You have the right to go through processes to make sure that you're not paying more than you should be paying. You have the right to challenge the IRS's position and be heard. And that means that they actually have to consider your arguments. They need to listen to what you're saying. You have the right to raise objections. You have the right to tell them that you disagree with them. And you have the right to provide documentation and evidence to support your point, and they need to consider it fairly. And they need to take the time to do that. You also have the right to appeal an IRS decision in an independent forum. If the IRS makes a decision about something with your tax account and you disagree with it, you have the right to go to a second level of review to make sure that somebody else looks at that issue and gives it a fair consideration. And part of what my office does a lot is make sure that people have this second level of review. You also have the right to finality. You have the right to know how long you have to contest or disagree with something. You also have the right to know how long the IRS has. They can't just come back at any time, at any point, and try to make changes to your tax account. They have to work within certain time frames, and you have to work within certain time frames so that we reach a final conclusion in all of our tax matters. You have the right to privacy. This means that when the IRS engages with you, it should be no more intrusive than is necessary to get the information the IRS needs. You also have the right to confidentiality, and this is really important. When you report information to the IRS, you can trust that the IRS is not disclosing that information to anybody but you. We don't disclose it generally to other agencies. We don't disclose it to other people. If you file a separate return and your spouse or partner calls us, we can't even disclose it to them. We don't disclose it to your children. We don't disclose it to other IRS employees. It is confidential, and your information is safe when you send it to the IRS. You also have the right to retain representation. This is right number 9 out of 10. You have the right to have somebody represent you before the IRS, somebody of your choosing. And you have the right to make sure that you have the right person by your choice standing before you and making your arguments to the IRS. You also have the right to a fair and just tax system. And really what that means is that you have the right to expect that your situation, all your facts and circumstances, all your arguments are going to be considered in a fair and neutral way by IRS employees when they're making decisions. So with that, I'm going to conclude my presentation. I want to thank the Office of New Americans for hosting me today, and I want to thank you so much for your attention to these important topics. I hope that you learned something new.
Thank you, Liz, for being with us and for giving us such a clear presentation. We hope this information was helpful. We hope that you learned a lot from today's program, and we look forward to bringing you more information that is good to know in Buffalo. My name is Jessica Lazarin, and I serve as Director of the Office of New Americans. Learn more about the office at the City of Buffalo website. Thanks for watching.